Hey everyone, and welcome back to the channel. Today, we're talking about something that's been on everyone's mind, gold and silver. These precious metals have been on an absolute tear, hitting record highs and capturing headlines. But here's the kicker, some major financial institutions are now forecasting a significant drop, while others are predicting even greater gains. What in the world is happening in the market, and where are we headed? Let's break down the forces at play right now, because the future of your investment might depend on it. Gold has been a star performer, trading near all-time highs, not just in dollar terms, but also when adjusted for inflation. We've seen spot gold briefly touch levels around $3,452 an ounce, with futures contracts surging past that, reflecting a period of incredible demand. In fact, gold recently rallied so fast, it climbed a staggering amount in just over 2 months, even outpacing the euro to become the world's second largest reserve asset. This kind of explosive growth, almost a parabolic rally since January, has left many investors wondering if the party can continue or if a significant correction is on the horizon. One of the most powerful drivers behind gold's recent surge is the escalating geopolitical tension, particularly the ongoing conflict between Israel and Iran. When uncertainty and fear grip the global stage, investors traditionally flock to gold as a safe haven asset, a place to protect their capital. We've seen this play out with increased missile exchanges and heightened rhetoric, which inevitably sends waves of anxiety through financial markets. The SPDR Gold Trust, one of the largest gold ETFs, has seen a notable increase in its holdings, clearly reflecting this flight to safety. Gold acts as a shield when currencies feel shaky, a reliable store of value when inflation looms, and a stable asset during times of global conflict. It's a classic move that has characterized gold markets for decades, and its performance has truly exemplified that role recently. Adding to the complexity are the signals from the Federal Reserve. The market is closely watching their every move, especially with expectations of potential interest rate cuts later this year. Lower interest rates typically make non-yielding assets like gold much more attractive, as the opportunity cost of holding them decreases compared to interest-bearing assets like bonds. Despite recent disappointing U.S. economic data, including a drop in retail sales and industrial production, the Fed is widely expected to keep rates unchanged for now. However, any hint of a more accommodative stance or a clear timeline for rate cuts, as suggested by the latest economic projections, could provide a significant boost to gold and silver, as the CME FedWatch tool has indicated a growing probability of rate cuts by the end of the year, a shift that could strongly support precious metals through the coming months. Real yields, for instance, have recently dropped to reflect these growing expectations of monetary easing. Beyond geopolitical turmoil and central bank policy, there's another major force providing a stable demand floor for gold: central bank buying. Central banks worldwide have been accumulating gold at an unprecedented rate. A recent survey by the World Gold Council revealed that a staggering 95% of central banks plan to increase their gold reserves within the next year. This trend, driven in part by a growing interest in de-dollarization, creates a consistent and robust demand for bullion, reinforcing its long-term bullish case. This institutional demand acts as a powerful undercurrent, supporting prices even amidst short-term volatility. Now, let's talk forecasts, because this is where things get interesting, and opinions diverge sharply. Some analysts, like those at Citi, are calling for a last hurrah for gold, predicting prices could fall by as much as 25% next year. They see the record run as poised to stop. However, others, like Goldman Sachs, maintain a decidedly bullish outlook. They're forecasting gold to reach $3,700 an ounce by the end of 2025 and even $4,000 by mid-2026, citing continued central bank demand and anticipated ETF inflows once the Fed begins cutting rates. Peter Cardillo of Spartan Capital Securities even sees a potential appreciation to $5,000 over the longer term. This divergence highlights the complexity of the current market, where strong underlying fundamentals meet potential short-term headwinds. From a technical standpoint, gold has shown a constructive setup. While it's currently consolidating and has faced some resistance near the $3,450 area, the broader trend remains positive. Analysts point to an ascending channel formation and positive oscillators on the daily chart, suggesting that any pullbacks could be seen as buying opportunities. Key support levels are around $3,373 and $3,340, while a sustained break above the $3,400 mark could open the path toward $3,450 and potentially the April all-time peak of $3,500. However, a bearish reversal pattern did form recently near the May high, hinting at a potential short-term pullback, perhaps towards the $3,313 level. This suggests that while the long-term trend appears to favor buyers, short-term caution might be warranted. It's also worth noting that historically, June has been a challenging month for gold, recording the lowest win rate and strongest negative monthly return over the past 43 years, with prices closing lower 60.5% of the time. This seasonality adds another layer of potential short-term weakness, even as the overall trend remains positive. Silver, often considered gold's younger, more volatile sibling, has also been making significant moves. It's been consolidating recently, but has shown remarkable strength, climbing above $37 an ounce and reaching its highest levels since early 2012. This rally is fueled not only by similar safe haven flows and easing rate expectations from the Fed, but also by robust industrial demand. Silver is a critical component in many industrial applications, from solar panels to electronics, and that consistent demand provides a strong foundation. Citi, for instance, forecasts silver could rise to $40 over the next 6 to 12 months, citing tightening availability and robust investment demand. Technically, silver is holding strong above key support levels, with sustained bullish momentum suggesting it could test resistance levels around $37.54, $38, and even $40 if the current trend continues. The US dollar plays a crucial role in all of this, as gold is priced in dollars. Generally, they have an inverse correlation. When the dollar strengthens, gold tends to face headwinds and vice versa. Recently, the dollar has shown some resilience despite weaker economic data, which has capped gold's upside. However, with growing expectations of Fed rate cuts, the dollar might weaken in the future, which would then act as a tailwind for gold prices. The interplay between dollar strength, economic data, and Fed policy remains a key factor to watch. So, what does this all mean for you? The precious metals market is in a fascinating, albeit volatile period. While some experts predict a significant correction due to historical seasonality and short-term technical indicators, the overarching narrative is one of strong long-term support. Geopolitical instability, continued central bank accumulation, and the anticipation of future Fed rate cuts all point to a robust demand for gold and silver. These metals are proving their value as hedges against uncertainty, and their role as a safe haven is as strong as ever. Navigating this market requires staying informed and understanding the multiple layers of influence, especially as various global factors sometimes pull in opposite directions. Whether you're considering new investments or reevaluating your current holdings, keeping an eye on these global developments will be crucial. Thank you so much for watching today. If you found this information helpful, please hit that like button, subscribe to the channel, and let us know your thoughts in the comments below. We'll be back soon with more market insights to help you make sense of your investments. See you next time.